We're excited to be hosting in person after a couple of years of COVID virtual presentations. Start with just a couple notes about Holland Hart. This is our 75th anniversary. We were actually founded in 1947 by a tax lawyer, Steve Hart, so this is kind of fitting. We have now about 500 lawyers in 8 states and in Washington, D.C. The tax group has grown quite a lot over the past few years. We have about 70 lawyers and specialists in the tax group. We've got a federal income tax practice, state and local, tax controversy, a really growing, burgeoning tax controversy practice, our employee benefits, and our private client or trust and estates group. We've got a nice range of topics today. We're going to start with Adam Cohen and Colin Olberg talking about probably a very hot topic on renewable energy tax credits and the Inflation Reduction Act. Got a panel, Rich Keeley, on abusive trusts, followed by Bob Keating on using LLCs as S corporations, which is a pretty interesting topic, something that we see a ton of in our practice in the West. And there's some new guidance on that is quite helpful in fixing a lot of the problems people fall into. We've got Arthur Hundhausen on a nice SALT update, and then a roundtable with our tax controversy group led by Bill Colgan. If you'd like CLE credits, we have affidavits at the registration table. They'll also get emailed to all of you after the event. If you want CPE credits, there's an evaluation form that will be emailed after the event, and you will receive CPE certificate after you complete that within 48 hours. Presentations today will run till about noon, and we'll have a break at 10:15. And we will share the slides that you'll get to see today by email after the event, and we'll have a video recording as well. So thanks for joining us, and welcome. You're welcome.
All right. Thank you, everyone, for making your way out here. So, Inflation Reduction Act was passed at the end of the summer, signed into law in August, and it had a major effect on energy credits. And so we're going to kind of focus on the primary energy credits of the production tax credit, the investment tax credit. In the materials, there's also information about the advanced manufacturing credit, the clean hydrogen credit. If we have time, we'll get to those, but you may have to study up in the materials. And if you have any questions, I just go ahead and welcome you to raise your hand, and we'll try and address them as we go. And so let's jump in. So the first credit that we're going to talk about is the production tax credit. And the way that they changed this is for a long time, 2 decades, the credit was a set amount per kilowatt hour that was produced by a renewable energy qualified facility. Now there is a base credit, and this is not a target. You're not trying to hit the middle. You're trying to grow to the biggest credit you can get. But now there is a base credit that is just 0.3 cents per kilowatt. That's before inflation adjustments. The IRS just issued a notice that said with the inflation adjustment, I think that base credit is like $0.0125 or something like that per kilowatt hour. So this is all of this is before those inflation adjustments. If you meet this new thing, prevailing wage and apprenticeship, and we'll talk about each of these, you can grow that credit by a 5 times multiplier. Okay? If you also then meet either domestic content or energy community, you get a 10% bonus credit. So you get that, whatever that was before the bonus, 10%, you add that on and you get that credit. And then if you do both, if you meet domestic content and energy community, and you have the multiplier, then you can get all the way to 1.8, again, before inflation adjustments, which is another 10%. 10% of the 1.5. So it's not 10% and then 10% of that. It's based on that original multiplied credit. This credit, just again, that new notice that just came out like 2 days ago, the 1.5 cents is like 2.75 into next year. So this new law also made some other changes. For example, it added solar, and then it added a termination. Now, you might look at that and go, okay, that's like what we've seen in past years, where the credit phases out or goes away, and then we have the Congress has to renew it. That's not what's going on here. Okay? Instead, they created a brand new credit, which Colin will talk about, that is to replace the production tax credit. So there is some overlap there, because this is a termination if the construction doesn't begin before 2025. That one is the credit begins if you place in service after January 1, 25. So there is a bit overlap, but the basic construct to walk away from is that this credit is here for the long haul, the production tax credit. In light of that, they eliminated the phase-outs. They changed the tax exempt cutback, but just slightly. They took away grants and things like that as a cutback. And they added this nice rule that if you pair a qualified facility under the production tax credit with clean hydrogen, then you're deemed to have sold the energy, even though you might use it yourself. So if anyone's interested in doing both the clean hydrogen with, say, wind or solar or something, you can get both credits and have that. You don't have to actually sell the electricity, which is otherwise still a requirement of the production tax credit, that you have to sell the credit to be able to, or sell the energy to get the credit. So what is prevailing wage? Because obviously people are not terribly interested in the base credit, right? They want the multiplied credit. The multiplied credit is where the credit has been over the past years, and so that's really where people are focused on. Some people call it the full credit. Prevailing wage, first of all, has some exceptions. It doesn't even apply if it's a small facility, meaning a maximum output of less than a megawatt alternating current. That less than 1 megawatt, don't know how that plays out over a facility. For example, if you have a solar facility with multiple arrays, can you make an argument that each array is less than 1 megawatt and get out of the prevailing wage? We don't know that yet. IRS is studying the issue and will get back to us. Also, there's this rule that said, okay, you don't need to meet this if you get going before IRS tells you how to meet it. And they recently did publish that. So the 60-day clock has started. We're now frantically trying to begin construction so that they can begin construction before January 29th. So if you don't get started before January 29th, what are you up for? You have a facility that's large enough. Laborers and mechanics, whether they're your employees or subcontracted, that are doing work on construction, alteration, or repair, they have to be paid wages at rates not less than the prevailing wage in the locality as determined by the Secretary of the Labor. And if you fail to do that, but you're still trying to claim the full credit, and you have to go back and pay the laborers and mechanics, plus an interest factor, and you owe the IRS a penalty. The IRS, before we get to that, the apprenticeship rules basically in the statute, again, they require this concept of building up the labor force in the United States by requiring a certain percentage of the total labor hours to be by apprentices. The first one really doesn't apply because facilities that began construction this year don't have to comply. So it's really 12.5 or 15% of labor hours that will need to be apprenticeships. You get to exclude certain people. There are ratios, generally state-based. I think almost every state has them. They generally, I was looking at this, they generally require that there be at least 3 journey workers to 1 apprentice or 2 journey workers to 1 apprentice. Somewhere in that neighborhood, there's a couple states that it's 1 to 1, but There is that requirement, the requirement that if you have somebody that employs 4 or more, then they must employ at least 1. There's also an exception there as well. It says, okay, if you tried to comply, then you're deemed to have complied. Trying to comply is you made a request and it was denied, or they simply didn't respond. We don't have a lot of detail around that, but there is that. And if you don't meet that exception, then you have to pay the IRS for the missed hours. And it's hard to read there, but it's $50. Or if you intentionally disregard the rule, it's $500 per hour. So then there's this new guidance. This was Notice 2022-61. So my complaint with this is that it gave us not a lot of information about how to make the rules work, but they started the 60-day clock. So what they did tell us is that you can go to the sam.gov website to find out prevailing wages for a lot of job categories, and if you don't, then you can send an email asking the Department of Labor to give you what the wages should be. The Department of Labor said, yeah, we'll respond timely, but proof is in the pudding there. They did, like I said, say that it's independent contractors or employees that get counted. You have to aggregate everybody. They also, this I think is probably the biggest piece of the guidance, which was, I think, nice, is that they defined construction, alteration, or repair as a similar set of terms under the Department of Labor regulations. And that Department of Labor regulation has this very nice site of work construct. It makes it clear that, okay, you don't have to impose prevailing wage on the people who sell you the wind turbines from their factory and wherever, but only you have to just keep track of what's going on at the site of the project. Still could be very onerous because it goes all the way down to whoever many subcontractors there might be, but at least you have a defined area where you presumably have some control over who comes on your site, and so therefore can track how many hours they're spending for apprenticeship and what's being paid to them for prevailing wage. In terms of that good faith attempt to address apprenticeship, where you have to make a request and they have to either deny or not respond, the IRS said you have to make the request in accordance with usual and customary business practices for these programs in the industry. Of course, this wasn't the law until August, so there is no usual or ordinary business practice, customary business practice. So who knows what that means, but that's what they said. And then they also made it clear that the ratios, in other words, the 1-to-3, 1-to-2, or the, if you have at least 4 employees, you need 1 apprentice. That's a daily thing. You have to make sure every day they're satisfying that. And then the labor hours, you get to aggregate. So within that confines of that project site, if one laborer, if one contractor has 10% of their hours and you need to 12.5, you can meet that with your own laborers or with some other contractor. You get to aggregate all of that. And they made it clear that it's the begun construction test, the test that says, whether you've begun construction by the 60th day, that the existing tests that are out there that we've been applying with a lot of uncertainty, but have been applying it, that of physical work or the 5% safe harbor, that there has to be continuity. I'm not going to really get into what those are, but that those do apply for these purposes, which was really helpful because there was some people out there questioning that. And I'll turn it over to Colin to talk about domestic content and energy communities.
Thanks, Adam. So yeah, another way to increase the credit amount. Adam talked about prevailing wage and apprenticeship requirements. It is through meeting the domestic content requirements. And if you can do that, you can gain an extra 10% of the total credit that you would be claiming. So this applies, as Adam, I think, mentioned, to facilities placed in service in 2023 or later. So, essentially, it means that if within your qualified facility, you're going to have to use U.S. produced steel, iron, and manufactured products. And so the rules kind of take two different paths. If you're using steel and iron as just components within your qualified facility, the Section 45 directs us to 49 CFR 661, which is the Buy America Act regulations, and directs us to kind of implement those regulations in various ways. But essentially, it means that 100% of the steel and iron that's going into your qualified facility has to be U.S. produced. Manufactured products are a little different, and basically, there's a lower percentage and applicable percentage that's a bit lower. 40% of the total costs of manufactured products that are attributable to materials mined, produced, or manufactured in the U.S., or it must be mined, manufactured, or produced in the U.S. So that would be like a manufactured product. It's not actually defined in Section 45, but there is a definition in another part of the CFR. But that would be basically if you're hiring somebody to build a transformer for you, or some piece of equipment like a manufactured component of your facility. So as I'll get to in a little bit, there is kind of a phased in percentage increase for these manufactured products, and so right now it's 40%, and it goes up a little bit starting in 2025. Another way to meet or to gain additional credits, another 10% bonus, is through energy communities, and this is basically if your qualified facility is located within what's defined as an energy community in Section 45, then you could get this additional 10%. So I guess if you're keeping track, you could be up to as much as 50% credit at this point. And so there are three ways, three definitions of energy community. The first is a brownfield site. If your qualified facility is located within a brownfield site, you can get this bonus credit. That basically is real estate or land that has been contaminated with pollutants or industrial waste or things of that nature. It also includes like a mine-scarred land or land that's been contaminated by a controlled substance. So if your qualified facility is located within a brownfield site as defined in 42 U.S.C. 9601, fairly easy, I think, straightforward to meet that extra percentage here. The second way you can do it is having your qualified facility located in an area with significant oil and gas jobs or tax revenues, and which also has high unemployment rates. So you'd be working with specific percentages of oil and gas jobs, basically any related to the extraction, processing, transport, or storage of coal, oil, or natural gas. And then the unemployment rate metric is basically if you're within this particular area, if you're at or above the national unemployment rate for the year before. So the third way you can meet this energy community definition is by having your qualified facility located in a census tract or adjoining to a census tract in which a coal mine closed after 1999 or a coal-fired generating unit was retired after 2009. And so this is where we've seen the most kind of activity recently with people trying to fit into this definition of energy community. And it certainly remains to be seen what this actually means. The IRS certainly will issue guidance at some point, but right now we're not sure what it means for a coal mine to have closed since 1999. There's not anything in the provisions that gives us much guidance in that way. Through some diligence, I mean, the Mine Safety and Health Administration maintains a database that is available online, and you can kind of poke around and learn as much as you can about particular mines within particular census tracts, but then it's kind of comparing that to where your qualified facility is located, and then using the data on that website, which is often incomplete. And so sometimes it's looking at like news articles, and so it really remains to be seen exactly what a taxpayer may need to provide in order to get into this exception, or this bonus credit. Same with a coal-fired electric generating unit. To my knowledge, there's not like a national database kind of collecting this information, but anyway, I think, yeah, people are very interested in gaining this particular portion of the bonus credit. So as Adam mentioned, there's a new Section 45Y. The IRA added this production tax credit, the Clean Electricity Production Tax Credit. This is effective for facilities placed in service after 2024. So it was kind of meant to replace Section 45. And instead of, as Section 45 kind of applies to specific technologies and renewable energy, it's got like a big list of biogas and bioloop facilities. And this credit applies broadly just to qualified facilities. So if you've got a qualified facility, meaning that generates electricity placed in service beginning in 2025 or later, and greenhouse gas emissions rates are not greater than 0, then you probably can fit into this credit. I mean, there's lots of other ways that you could fall out of it, but that's the broad scheme is that it's based on qualified facilities. Credit rates are generally the same. The same prevailing wage and apprenticeship requirements apply here as well. Domestic content, energy community adders that I just spoke about. 10-year credit period, and there is a phase out which begins when the secretary, it's based on an applicable year, but basically when the secretary determines that greenhouse gases from all electricity production in the U.S. are at 25% or less than 22 levels, then that kind of starts the clock on the phase outs. And so if you begin construction the year after that year, you lose 25% of your credit, and then it kind of phases out from there. So with that, I will turn it back over to Adam.
Great. So we took you through all that on the production tax credit side because once you understand those constructs, the prevailing wage, the energy community, all that stuff still applies to the investment tax credit. So it's the same sort of thing. The investment tax credit, instead of being based on the production of the electricity, is based on how much you spend on the facility. And so it also has a base credit and then a multiplier and then the adders, and that's where you get to that 50% that Colin mentioned. So this does not have an inflation adjuster because it's based on costs, which themselves have inflation built in, right? So you can even get up to potentially a 70% investment tax credit where the government's paying 70% of your costs if it's also in a low-income community that's an energy community that has domestic content that has prevailing wage. So you could have a really supercharged credit in some cases, and there are projects out there. Just like with the production tax credit, it has a similar termination. There's also 48E now that will take over essentially after that, so it's not really a termination, it's a change from one credit to another. Phase outs were eliminated because the tax exempt's the same. The real big changes here that are new and different and exciting are really this first line, frankly, where energy storage now can be its own qualified facility. For a long time, if you wanted to put a battery on the grid, you had to pair it with a solar facility or with a wind facility and qualify it that way. Now, any battery that's out there can qualify for the credit itself, which is really important for our the stability of our grid and the ability to transition to the new energy. There's also a clean hydrogen. These other ones are smaller issues, I think, for a lot of, or I'd say more niche in terms of who will be claiming them. The slides get a lot shorter because it's the same rules as prevailing wage. It's the same rules on domestic content. And then, were you going to talk about this one?
Yeah.
Okay, great.
I know we're bumping up on our time here, but yeah, same on domestic content as well and energy. So this parallels the 45Y clean electricity production tax credit. It's kind of the same idea here, 45 or 48E clean electricity investment tax credit, meant to kick in starting in 2025 or place in service facilities in 2025. Again, it's kind of technology neutral, so it applies to qualified facilities. And as Adam mentioned, energy storage technology is kind of the big change here. Similar credit rates, I think Adam mentioned the low-income community adder, so it's up to 70% of potentially credit here, which can be significant. So I think we really are bumping up on time here, and so I don't know if we'll get to that. Could ask about questions or.
Yeah, well, let me just really quickly mention, just because it is another really big part of the law. Hopefully Rich doesn't kill me for using up a minute of his time. So two big changes is direct pay and what people sometimes refer as direct transfer. Direct pay is this idea that there are certain types of organizations that can get money directly from the government in terms of the credits. State and local government doesn't pay federal tax, but they can get a payment for the credit if they do a renewable energy project. There are some, the clean hydrogen, carbon sequestration, and advanced manufacturing, where anyone can get that same direct payment for it. And then direct transfer is this sort of game changer where for a long time, if you wanted to do an energy project, but you didn't have the tax capacity yourself to be able to take the credits, you had to do a partnership with somebody that does have that kind of capacity for them to get the credits and you to get the capital. Now, with direct transfer, there is an ability to literally sell credits, which the IRS has been fighting in loads of cases, that they claim partnerships are sales and that you shouldn't be able to sell. Now Congress says, absolutely, you can sell. So lots of interesting issues and rules in these areas, but unfortunately, we're out of time. So I'd like to welcome up Rich Keeley, who's going to talk about abusive trusts. And I think you'll really enjoy it. Him to his presentation. Like I said, lots of material here. Feel free to out to Colin or myself if you have any questions. All right, there you go.
Thank you. Well, good morning. My name is Rich Keeley. I work in the tax group with the private client group doing trust and estate planning, but I primarily work with private trust companies, corporate fiduciaries, and be trustees, personal representatives of estates, both here in Colorado and Wyoming. Advising them on the administration of estates and trusts. Also work and do litigation when things kind of go wrong, and there might be some sort of breach of fiduciary duty or similar things, and then also work with our tax controversy team when we end up in tax court. So we are talking about, I was going to say sex, drugs, and abusive trusts, but it doesn't have the same ring as sex, drugs, and rock and roll. But abusive trusts, if this was a year ago, 2 years ago, we would be talking about all the changes in federal tax code that were coming. They didn't come, if you didn't notice. There were no changes for the most part. just as a kind of an aside, don't expect changes in my mind until 2025, right? That's when the current legislation sunsets. So what are we talking about? Foreign and domestic trusts. We're talking about personal trusts. We're not talking about trusts that you might have in some other context. And these are trusts that are designed to evade U.S. taxes. We are not talking about trusts that are meant to avoid legally U.S. taxes. We're talking about trusts that are designed to illegally avoid U.S. taxes. So none of this should apply to any of you, and none of you should have any concerns. Don't ask any questions saying, I've got a client, or friend that is doing any of this, because then I will have to testify. So, what else are we talking about? How do they do this? They hide the true owners of the assets or the income. Or they're going to disguise the substance of the transactions. And those are kind of the two key things that when we're talking about these trusts is going to fall into one of the two categories: hiding the owners or the assets or income, or they're going to just simply disguise it. And when I say disguise it, some of you are thinking like, that's not, you can't do that. And you're right, you can't do a lot of these things. And some of it, there's no good explanation for other than this is what has happened. So why are we talking about it now? Why is this important? So as you probably have seen, the IRS is on a hiring spree, they would call it. And that includes specifically 200 attorneys that they're going to bring in for looking at abusive tax deals. And this is literally job openings posted. That's what, if you read the job openings, they're kind of humorous. It sounds like a great place to work. That's all I would say. So the question is, number one, when are these people coming on? Can they actually do it? The intent here is obvious, right? We're coming in to abuse or combat abusive tax transactions that threaten to undermine our tax system. Just a couple of things that I would point out, though. This is a huge, huge job. There's about $79 billion in funding that was added to the IRS's budget. Of that, $46 billion is going towards enforcing tax laws, and the rest will be for modernization and similar things. And the question is, how does the IRS employ this? They're attempting to hire 87,000 new people by 2031. They're also, at the same period of time, facing about 50,000 people that they estimate will kind of retire, resign, leave the agency over that same period of time. There's also a backlog of understaffing, which I'm sure you all, if you try to call or contact the IRS, has been caused by flat funding that they've had over the last, since 2010, essentially. And then there's the question of, can they actually hire 200 people, let alone 87,000 people? Right now, the IRS had the goal of hiring, I think, 5,000 people in 2021, and they hired 3,500. So they're already behind the ball. They also, just kind of as a track record, and I don't mean to bash the IRS here, but just it's a challenge that they face. Between 2017 and 2019, there were 5,000 funded positions that they were unable to fill. So you hear these numbers, you see them, take them maybe with a grain of salt. Then the other things that you probably have heard, if you haven't been following this is Robert Brockman, and we'll be talking about him a little bit more. The largest tax crime ever that was been discovered, $2 billion worth of income that were hidden by Mr. Brockman through a series of entities and trusts in Bermuda and Nevis. Fact about Nevis, Alexander Hamilton, that's where he was born. John, so anyway. So this is, it has come to the attention of the press. It's a politically charged issue. As you can imagine, billionaires these days don't have a lot of public capital to spend. And essentially what Mr. Brockman did is around $2 billion worth of assets overseas. He pled not guilty. He died right before his trial. So this is an article from 2020. He died, I think, 2 months ago. The other part of it that is going to bring attention to trusts is the Corporate Transparency Act. And so trusts are not reporting companies, but they are beneficial owners of reporting companies. And if you've been following the Corporate Transparency Act, that is going to require disclosure of beneficial owners to FinCEN, who keeps a database. It will be private, but it will be accessible by Department of Justice and the IRS. And so who are they going to disclose when it comes to trusts? They're going to disclose the trustees and then beneficiaries potentially. And then also there'll be circumstances For the individual who sets up these trusts will have to be disclosed as well. So names, addresses, all that stuff that was previously private is going to be very much public. Well, relatively public. So let's turn now to what are legitimate trusts. A legitimate trust is going to be a separate legal entity created by trust document. You're going to have an independent trustee who exercises control, owns the assets in name, controls them, and manages them for the benefit of the beneficiary. And then you're going to have separate tax reporting. Trust file 1041, K1s, that stuff goes out to beneficiaries and is reported to the IRS. Key here for when we're talking about abusive trusts, in contrast to legitimate trusts, all income, right? All income is going to be taxed either to the trust, the beneficiary, or the grantor, depending on how it is distributed. A legitimate trust also has certain deductions it can take. They're limited. They are still allowed to take some, what we call, the miscellaneous itemized deductions. And they can also eliminate income, at least on their 1041, making distributions to beneficiaries. And that's a key part here because that's a element that is exploited by these abusive trusts that we'll talk about here in a second. So, to walk you through an example, if you guys aren't familiar with, or you don't deal with trusts all that often, Trust A earns $5 million in income. There's $1 million in fees and expenses that are incurred, and it distributes $3 million out to its beneficiaries. That's a pretty reasonable fact pattern. How is that characterized? So, the trust on its 1041 takes a deduction of $1 million for the fees and expenses, and it's going to take a deduction of $3 million for the amounts distributed to beneficiaries. The remaining is going to be taxable income taxed to the trust. And then on the beneficiary side, they report the $3 million in income they have. So what are some legitimate other administrative expenses? The test is essentially, is it something that would be incurred if the property was not in trust? And if it is, then that's not a legitimate expense that you can deduct. And you'll see again, we start looking at some of these abusive trusts, that is an element that is exploited. So, turning now to your abusive trusts, domestic and foreign trusts, two different things, different rules apply, but similar fact patterns here. First of all, if it's not a domestic trust, it's a foreign trust. Easy enough, right? And domestic trust is going to be one that passed both a court test and a control test. Your court test is essentially saying, or asking, is the trust subject to jurisdiction within the U.S.? It's going to be supervised by a U.S. court. There's some tests you can look at under probate code and things like that that are referenced, but that's really the bottom line. Then the control test is asking whether a U.S. person has the ability to exercise control over all substantial decisions, right? So distribution amounts, selection of beneficiaries, trust termination, things like that. So the bottom line is when we're talking domestic trust and the rules applying to domestic trusts, you got to pass both this court test and control test. So here are your general schemes as characterized by the IRS for domestic abusive trust schemes. We'll start with this first one, and this is an actual ad for Hoffman Associates, who in 2022 was indicted, ultimately was convicted. I think they had a combined amount of about $17 million worth of income that they had hid for individuals. They put this in a newspaper. I don't know who calls it, but somebody did. I tried calling the number this morning, and it's now a health advocate organization. So, also sounded kind of shady. So anyway, this is the kind of stuff they put out. They have websites. They have all the things that you would expect. So my point is simply, don't assume you or your clients or whoever you're working with are too smart not to fall for something like this, because there are a lot of sophisticated people that fall for these things and call in these numbers. And what generally when we're talking about charitable trusts, what the idea is that we're putting money into a trust that's designed to look like a charitable trust, a legitimate charitable trust. And the reality is, it's just not a charitable trust, or they're going to mischaracterize deductions and distributions that come out of it and make payments back out to the person who created the trust. Take these deductions and then they call it good. In Hoffman, what happened there's about 70 CRATs, so charitable remainder annuity trusts. And what would happen is, settler creates the trust, puts $1 million in it, let's say, of like a business or company assets. They would then recognize no gain on that transfer of assets. The trust would take a step up in basis. Again, if you're thinking, well, you can't do that, that's right, you can't probably do these things. And then the trust would go around, turn around, sell it, purchase an annuity, pay $5,000, to the University of Michigan or wherever, probably USC, and pay that amount, and then turn around and the annuity payments go back out to beneficiaries, right? And that amount that was paid back out, Hoffman and Associates, who was kind of one-stop shop, would advise and file all the tax planning or tax documents as well, wouldn't report the income back out to beneficiaries. They did that. I think there's 70 CRATs they identified. There's 19 audits. They found about $17 million worth of assets that were, or income that was underreported. The IRS has identified CRATs specifically as it's part of its dirty dozen for this last year, so it is an area of focus. We talked a little bit about the changes that were being attempted last 2021, 2020, and those were not necessarily targeted at CRATs and these charitable trusts, but at grantor trusts. And again, it's some of these things that are being abused. So it wouldn't surprise me down the road, you'll see some changes around charitable trusts. So we'll see though. Next item is family residence trust, not QPERTs, if you've heard that. So qualified personal residence trust, that's a totally different thing. What we're dealing with here is really just simply someone putting a house, vacation home, something like that, puts it into a trust, and then they try to turn around and take all these business-type deductions by claiming that now the trust is operating a rental property that rents it back to the beneficiaries. And the beneficiaries, in some of these cases you read, don't pay rent. They essentially continue to exercise control of the house like it is their own. And the trust would characterize the beneficiaries as employees of the trust, therefore paying off their rent, all these kind of weird, bizarre things that they would do. So bottom line, this is another area that is prone for abuse. And then the next area is these business trusts and equipment service trusts. I think this is probably the more popular spot where people have heard of them. Sometimes you'll hear pure trusts, constitutional trusts, really crazy stuff that contrail kind of people would talk about. But the reality is they're out there, people fall for them. The idea is, again, take a business interest, transfer it into trust. Beneficiary or the settlor of the trust recognizes no gain on that transfer. Trust takes a step up in basis. They can then either turn around and sell trust to the business to like multiple layers of trust. And as they go through those layers, you're taking distributions of income to another trust. Trust A takes a deduction for that income. Trust B turns around and does the same thing. And so you'll have this kind of money laundering process here where 5, 6 trusts in a row can essentially eliminate income by taking fake deductions either to beneficiaries or to for these not legitimate deductions for trusts. Equipment service trust typically goes alongside those where assets of a business, say trucks, put into trust, rented right back to the business trust. So they kind of go hand in hand. Same things, they will just take improper deductions and kind of wash out the income. Those are your domestic trusts, right? So those are pretty common. They're here and they're going to be targets for the IRS. Now looking at foreign trusts, and this is, I think, the more interesting stuff. It gets on the news, tax havens, we're talking about all these kind of exciting topics. The pattern's pretty simple though. You create a trust in a foreign jurisdiction and you distribute US-based income to the foreign trust. Turn around, have the beneficiary of that trust be the next trust in the foreign jurisdiction and distribute income from Trust A, Trust B, and in that process, they say, well, it's no longer US-based, there's no reporting requirement, we're going to just not report this income anymore to the US. They will then turn around, some way or another, find a way to get money back to beneficiaries. It could be loans, it could be things like that. The bottom line is, the settlor, the US-based resident who creates these things, typically has nominee trustees, nominee companies. It's all fake, and they are still exercising control. So this is going back to Robert Brockman. This is one slice of his broader scheme. And what you'll see is down at the bottom, it's hard to see, but Augustus Investments LLC is a Delaware LLC, passes income up to Edge Capital Investments. It goes through a number of different LLCs, finds its way back up to the Alphas Charitable Trust. It's in Bermuda with non-US trustees. The reality is they were friends of his. His attorney that set all this up was the trustee. This Tammon guy is trustee of all these things, and he's just a nominee trustee. That line that flows out from Alpha's Charitable Trust up to the top goes ultimately to Robert Brockman back here in the US. So what you would see is, like I said, US income goes overseas, passes through these trusts. The identity of the beneficiary of these trusts is secret. There's no way to find it out, and it flows back up to Robert Brockman. Here's his broader scheme. And this is how you money launder $2 billion worth of income, or whatever you want to call it. Here's the Edge Capital slice that we talked about. This one over here is the one that was the more publicized form. Robert Brockman worked with Robert Smith to create Vista Equity Funds, which was a very large private equity fund. Made a lot of money, same kind of process, it's a little more complicated, but money passes up through overseas entities into a trust and back up to Robert Brockman. He bought a house in Colorado, down here, a jet over here, something like that. So, worst case thing though, here to point out, again, you don't want your name or your documents to have a sticker on it. So, I mentioned before that Robert Brockman died before his trial. A couple things that are, I don't know, it's a very ironic result for this whole thing. So Robert Brockman meets Robert Smith, they create Vista Equity Funds, and Robert Smith he was in the news maybe 2 or 3 years ago, paid off tuition and loans for a bunch of students at a university down south. So Mr. Smith enters into a non-prosecution agreement with the government to pay $150 million on the $200 million that he didn't pay for his own scheme. No prosecution against him, and he testifies against Brockman, and he also testifies against the attorney that was responsible for this, Carlos Kepke. Carlos Kepke committed suicide last month, the day before his trial. Robert Brockman died, I think, a month before his trial. And Robert Smith is doing just fine. So you can see Robert Smith, he has he's giving presentations, he's a public figure still a billionaire, and he's doing just fine. So kind of an ironic result. I'm sure whoever was prosecuting that case felt very disappointed about that. Yeah.
How did they escape tax?
It goes back to, like I was saying, like if you're like, this doesn't make sense,
Yeah.
it's because it doesn't make sense. The bottom line is that the income just wasn't reported back. So they hide. The key things here, and this is where I think the changes the Corporate Transparency Act will impact folks, is that by moving it into overseas LLCs and overseas trusts, ownership and beneficiaries are concealed. And so for all intents and purposes, the U.S. doesn't know any of these things exist, right? There's no reporting back to the U.S.
I was just wondering how there was no.
No what? Yeah. I don't know. I don't know the answer to that one. It could be that, they're paying to foreign companies and they just didn't withhold. I don't know. I really don't know. But bottom line, that's kind of the structure. So what does the IRS do to enforce and go after both the U.S. or domestic and foreign trusts? First question you got to ask, is it really a trust? There's 1,000 things out there. People say it's a business trust. Business trust isn't even in the tax code, that term, right? So there's all these things, and the question is it a trust? And the test is basically, is the purpose to put the control into the trustee, the conservation, protection, property for beneficiaries? And if it doesn't fall into that, then it's going to be characterized as like an LLC, partnership, some sort of corporation or other business for profit. And in that case, they'll just apply those sorts of rules and go after you for income in that way. The sham transactions, form over substance kind of doctrine, that's the key thing that they'll rely on. And they're going to look at a couple areas. So lack of change, retain control, retain benefit, and the lack of an independent trustee. As I mentioned, in the Brockman case, a lot of those companies were nominees. and there was no real separation of ownership. The emails back and forth, they're all part of the government's file. You can go find it now if you want to read them, but it's kind of just embarrassing, you know, after the fact, all those things come out. He would refer to the IRS as, he used fishing terms. I can't remember what he referred to them. There's like fish names and then the permits and things like that. Anyway, so lack of change. There's no shift from really the relationship of the grantor when he owns the property separately to after the fact when he gets rid of it. Retain benefit, retain control. The beneficiary, like in the context of a residence trust, they're just using it like it's their own. These are the factors they're looking at. And then the lack of an independent trustee. So again, some of these indicators, and these are from the audit guidance that the IRS has internally. These are some of the things that they're looking for fact-wise. So identities are concealed of the parties. The sole beneficiary is like a foreign trust. It's kind of a red flag. Beneficiaries are discretionary. There's all these other kind of things that come up that will set off some red flags here. And I'll quickly skim or get through the rest of these. The grantor trust rules, there's a bunch of conversation about changing these. That's a big factor. So if you can't set it aside the transaction in a sham doctrine, you can look at these grantor trust rules. And the idea is essentially if settlor creates a trust but retains an economic control or control over the assets, we're just going to say they're his assets still, his or hers. And then when you look at foreign grantor trusts, same kind of thing, except the test is a little bit easier. The question is simply, has a U.S. person, so a corporation, whomever, transferred property into the trust? There are U.S. beneficiaries. That's the case. And in a proper world, it's a grantor's trust for those purposes. So there's no, what Brockman did of trying to transfer his assets into trusts and what other folks have done, you can't theoretically do that. And I believe there's also a step up in, it's considered a transaction, and there'll be gains and everything you have to recognize when you transfer it to a foreign trust. So just to kind of conclude here, why are we again looking at, I think, some increased enforcement in this area and why it should be something you think about? These high profile cases, Brockman, like that just happened. And it doesn't look great. There's gonna be a lot more that they're gonna find. And I'm particularly concerned, but this Corporate Transparency Act is going to be big for domestic trusts. There are a lot of entities, and this I think is generally speaking, there are a lot of business entities that are organized where the owners are just not filing, and they're going to track those down pretty quickly. If I was IRS agent, I'm going to run some report A that shows all the beneficial owners of these companies, pass-through entities, and then try to find and see if they're actually reporting and filing on their end. And I think there's going to be a lot of cases. And again, hopefully they can staff these things. And I am all done.
We actually have one more before the break. We have someone who is joining us virtually.
I'm of counsel with Holland and Hart. I practice to some extent in the tax and to some extent in the business organizations area. What I'm going to talk about today is essentially the not a choice of entity between S corporations and LLCs taxed as a partnership, but rather once you've decided that you want to be an S corporation, can you use an LLC as the state law business organization for the purpose of conducting your S corporation business? I've included here a couple of general points, and the one in the middle is something that will drive most entity tax lawyers crazy. The middle comment is one that often gets made to tax lawyers, and it will drive them crazy in this particular area. An S corporation is not a corporation taxed as a partnership. It's a very different entity, and that's going to have some consequences, particularly if you're using an LLC as a S corporation. Not going to spend a lot of time talking about comparisons of entities, but there are a few things here that I think are of significance in making the determination in the first place whether you want to be an S corporation. From a state law standpoint, things like charging orders and the ability to have a very flexible management structure can argue in favor of an LLC. The distinction between the way the S corporation rules work, which default to C corporation kinds of analysis, and the way partnership rules work are going to be really important because the partnership rules are based on the state law partnership structure, and the S corporations are based on the state law business organization structure. In particular, there are rules, and I think this may be one of the bigger issues to consider, dealing with the treatment of compensation in the case of S corporations and subchapter K organizations. And it's important to remember that once you've elected to be an S corporation, you've bought into lock, stock, and barrel corporate tax rules so that the concepts like Section 83B and the use of charging orders are going to be governed by corporate rules, not by partnership rules. This is sometimes argued as a reason to be an S corporation because you have a little bit more control over the application of SECA, but particularly with the advent of the net investment income tax, that may be overstated. And as we'll discuss in a couple of minutes, it's also true that although the S corporation distributive share of income may not be subject to SECA tax, and you may even be able to avoid the NIIT, to the extent that you want to have flexibility, you're going to have to do it probably using your compensatory portion, and that's going to be subject to FICA tax. An S corporation, a disregarded entity, a single member LLC, can also be an S corporation. A lot of what we're going to discuss in a couple of minutes about what you need to do to comply with the S corporation requirements, particularly in the context of separate stock classes of stock, will not apply in the case of a single member LLC because the measures are made with respect to the outstanding interests. And if only one person owns all the interests, then the outstanding interests are identical because there's nothing to compare it with. So why would somebody want to use an LLC instead of a state business corporation as the form of entity in which to operate an S corporation? A couple of the reasons relate to just the facts and circumstances of the situation. But the two items that I've seen come up in forming a new organization generally relate to the fact that the LLC is not subject to the limitations that a business corporation is with regard to management decisions and governance, thereby giving more flexibility. And as we'll mention in a minute, those items of flexibility will not affect the ability to be an S corporation. And in some cases, the owner of the organization wants to take advantage of state law charging order protection. There historically have also been some circumstances, particularly in Texas, where the state law form of entity governs the franchise tax, notwithstanding what form of entity it's treated as for tax purposes. And then finally, as with so many things in the practice of law, the response that I sometimes get when I ask the question, what could you have been thinking, is Isla-Guyot. It seemed like a good idea at the time, and I find that applies to any number of circumstances and you may be dealing with that. Okay, there are essentially three ways that an LLC can become an S corporation. It can elect to be an S corporation at the time of formation. It's simply filing a 2553, or if it has subsidiaries, they're filing a Q-sub election. And that's a reasonably straightforward process. But there are two other ways that an LLC can end up being an S corporation. The first is if it's a successor to a subchapter K entity. That is, if it's been operated as either a subchapter K entity or, for that matter, a disregarded entity, and it files an election, or an LLC taxed as an S corporation merges with the subchapter K, or there is a conversion of a subchapter K entity. These are all actually taxable transactions. We'll say a few words about what happens there, but that is not simply filing an election for an LLC that's been taxed as a partnership will not be a tax-free organization. And then finally, it could be the successor to an existing business corporation taxed as an S corporation, either through a merger or a state law conversion. In those cases, it will generally be a tax-free transaction, provided that the change from business corporation to LLC qualifies as an F reorganization. So, and I'll say a few words of that about that in a moment. Probably the most important requirement for an S corporation is that it may not have more than one class of stock. It also must be a domestic corporation, which includes an LLC or other eligible corporation taxed as a corporation, and it cannot have more than 100 shareholders. The single class of stock rules are the things that generally create the most concern in setting up an S corporation LLC. As I mentioned earlier, the S corporation rules track those that that are applicable to state business law corporations, in which, absent special rules, all stock is fungible, all stock equally shares per share in the economic results. The default partnership rules, which are generally what underpin an LLC, have an economic structure that's entirely different based upon tracking the amount of capital that's contributed and having separate rules applying to allocations and distributions. In addition, there are several issues that come up in the ordinary subchapter K circumstance that may be included in the operating agreement or may be part of the other agreements. And all of those, to the extent they have an effect on the economics of the S corporation, will need to be thought about. So, for example, options create issues as to loan distributions and buy, sell, and redemption consequences. It's important to recognize that when an LLC files an S corporation election, a 2553, that has the effect of also being an election to be treated as a corporation for tax purposes. It's an important thing to realize that when you make the election, you have now bought into the corporate world, and if in fact you subsequently decide that you don't want to be an S corporation, Revoking the S election, which the shareholders can always do, doesn't take you back to being, if you were a subchapter K organization, doesn't take you back to subchapter K. It turns you into the worst of all possible alternatives for most taxpayers, a C corporation. There is a certain amount of protection in that the regulations say that the S corporation will only function, the S election will only serve as an election to be taxable as a corporation if it's successful, which means that a defective S election theoretically will be of no effect in the organization if it was a disregarded entity or subchapter K, will remain in the form it was before. The rulings, the government has tried to be very obliging in terms of allowing people to correct defects in their initial election. And a lot of the rulings, notwithstanding this language, take the position that if in fact you can successfully avoid whatever the problem was in terms of your initial election, you can be an S corporation from the time of the initial election. I've only as a matter of information, I have compared this with what happens with a tax exemption where the election to be treated as a corporation is effectively treated as filed when the entity claims 501 or exempt status, even apparently if the organization somehow does not succeed in obtaining it. The IRS has ruled in several private letter rulings that an election by an LLC with traditional subchapter K architecture, which is your standard operating agreement, including capital accounts and liquidation in accordance with capital accounts, will not qualify as an S corporation if it's a multi-member LLC. And the letter rulings make it clear that that's true if that's what the operating agreement says, and quite frankly, that's also true if you haven't, articulated the economic relationship, but are just defaulting to the state LLC statutes, which also have generally a capital account kind of structure. If in fact you have an organization that is treated as a subchapter K organization and has elected to be treated as an S corporation, what you're going to do is you're going to effectively, the partnership contributes all its assets to a new corporation under 351 and then liquidates under the partnership tax rules. So that is not necessarily a transaction that gives rise to taxable income, but it is a taxable event and may give rise to taxable income, and you should be aware of that at the time the election is made. I've included a list of private letter rulings that talk about the rules that an S corporation LLC would have to deal with, but you will not see more rulings in this regard because as of October 11th, the service issued revenue procedure 22-119, which is available for LLCs that for one reason or another have not complied with the requirements to properly form an S organization. It's not limited to LLCs, but it deals with essentially any defective formation, and it has specific rules as to how to correct such things as provisions in the operating agreement that deal with that create separate classes of stock, issues of appropriate consent, and other issues as to qualifying as an S corporation. a lot of what's in this revenue procedure look a great deal like what's in the private letter rulings. But the interesting thing, and this reflects, I think, the government's uh, attempt to make everything okay for S corporations. Essentially, there is no filing that is either mandated or permitted. There is a simple statement that's included on the S corporation's return to the effect that we had a problem and we've solved it. But there is a document that must be created, as I read it, simultaneously with the discovery of the problem and the resolution of the problem that must be signed by the shareholders and maintained in the records of the LLC or S corporation for as long as it may be relevant. And that strikes me as meaning forever, because certainly the qualification as an S corporation is going to have effects throughout the course of time. The revenue procedure says that if you can do this with this sort of self-help approach, you cannot file a request for a private letter ruling. It also says that the service will no longer entertain what it calls comfort rulings dealing with S corporation status. So that to the extent that you look at the LLC and determine that it does have problems, this is going to generally be the way you're going to address them. Again, as I said, they have to comply, an LLC have to comply with S corporations requirements, and the operating agreement, which is referred to in the revenue ruling as a governing provision, must basically do these things. It's got to address the rules and impose the rules applicable to corporation, take the state law financial structure from one based on the partnership model to one based on a business corporation model, and then provisions, and this is a concern that is particularly acute, provisions that you have that relate to the distributions going to shareholders in S corporations need to be adjusted, including buyout provisions, liquidating provisions, and need to be made to conform with the corporate rules. So many of your cross-purchase arrangements and your purchase in the event of default or purchase in the event of capital structure change need to be looked at very carefully to see if they apply. This is a general rule that I try to apply when I'm looking at the operating agreement. Just ignore the old things that you used to worry about and look at S corporation and general subchapter C rules in order to make sure that your operating agreement actually accomplishes those things. You're going to eliminate capital accounts. When I'm doing this, I draft in terms of shares or units rather than percentages, and making sure that the way that the S corporation LLC works throughout its life, even in the event of extraordinary transactions, mirrors that of a corporation. That means that each shareholder must have an equal share, and they refer to it as economically identical in the rule to regular distributions, liquidating distributions, and redemptions and cross-purchase provisions. This is the last point I'm going to make in connection with this, because there is a terrific amount more, but this is probably the most important issue. The equity ownership, which is like a share in a corporation, cannot vary. You can't have special allocations or anything else. There is also a requirement that to the extent you're making compensatory payments, those payments have to be treated as payments to an employee. There's a lot of litigation in all S corporations about unreasonably low compensation. In this set of circumstances, you need to really think about those issues and realize that you're probably going to have, either within your operating agreement or as a separate document, an employment agreement. In employment agreements, you can provide for certain kinds of bonuses, but those bonuses will be compensatory income subject to FICA taxes. You need to bear in mind that with an LLC, when somebody leaves the LLC, they give up everything, including their right to compensation. With an LLC that's an S corporation, you need to account for both the equity ownership in the LLC and the termination of employment. And there is also an attempt, and I can't give you a universal rule. There's very often an attempt not to characterize these owners as employees for non-economic purposes, so that you're not dealing with, for example, employment law when a certain member leaves, which you wouldn't be in an LLC. My assessment, I don't know that there are a lot of cases on this out there yet, but my anticipation is, at least with regard to a lot of the taxable employee kinds of issues, that an attempt to characterize a member who is receiving compensation is not going to be successful. The right of informations to shareholders, and as was discussed earlier, the information required about shareholders for purposes of the Corporate Transparency Act will be subject to the same rules as applies to a corporation. And one of the final issue, and then I will close this down. The final issue is, once you've set up this complex structure that looks like an LLC, carries a lot of the state law LLC rules governing the relationship of the members inter se, but has very strong corporate-like economic rights, to the extent there is an internal fight later on. Ordinarily, in a partnership, when there is an internal disagreement, there may be a readjustment and a reallocation of income, which may go as far as actually going through the partnership audit rules. With an LLC that is not a partnership for tax purposes, but is an S corporation, you add an additional problem in internal fights, that you don't have the flexibility to resolve the issues if the resolution is going to cause something to cease to qualify for the single class of stock rules. So it does make internal fights a good deal more complicated. I haven't covered everything that's in the slides, and I commend the rest for review, but I think I've exhausted my time. So to the extent that there are questions on this, I'm sorry that I won't be there to address them directly, but you should have my email address, and please feel free to send any questions to me at that rate. With that, I believe we've come to a 10-minute break, and I will.
Okay, so my name is Arthur Hunhausen, and I've been with Holland Hart since 1998, which is hard to believe. Main part of my practice focuses on salt, with a focus on Colorado, but many other states as well. And from year to year in this conference, I never know what you guys are interested in particular. The people that present with me and have done that for years remember that way back when we started, we got a comment that every one of us should cover in our presentation, the storage of nuclear energy materials. So if that person is here today, I'm sorry, I don't have any slides covering the state taxation or Colorado taxation of nuclear materials, but I do have a number of topics that have caught our attention over the last 6 to 8 months and have caught the attention of some of our clients as well. And we'll just dive in, one of the main issues that we've seen a lot of interest, I have the feeling that some of you have been tightly involved and pretty intensely looking at the Colorado salt workaround, and then for others of you, it's kind of in the distance. Right now, it's kind of the Wild West. We have rules, we have statutes, we have some Department of Revenue input, but not a whole lot. So everything that I'm going to be telling you today is subject to the caveat that it could change and there could be clarifications. But you all know what happened in 2017 with the Tax Cuts and Jobs Act. One of the many impacts of that act was to say that going forward, individuals would be capped at a $10,000 deduction for their state and local taxes. That has caused and continues to cause a lot of consternation around the country. And so many states have tried to implement these special workarounds to get individual residents in those states the benefit of the deduction that would have been available to them before the passage of this act. And the most common form of this workaround is to say that if you have individual owners of a pass-through entity, the tax that would have been payable by the individuals on the outside of that entity now becomes payable as a separate entity-level tax directly imposed on the entity, and that effectuates an unlimited deduction for the owners on the outside that we'll go through. So on a simplified basis, when a state does this, including Colorado, there's 3 basic steps that I see. Step 1 is that the entity actually calculates and pays the tax that would otherwise be owed by the individual owners on the outside of the entity. Step 2, the entity at the entity level gets a deduction for reducing the amount of flow-through K-1 income to the individual owners without any limit. That's the key. You're translating it to the entity, and there's no limit on that deduction for the tax paid by the entity. And then step 3 is the one that I always forget, is that when you have this flow-through effect, there's still income going out being reported to the outside owners, and so you need to give a deduction or a credit so that they're not paying the same tax or paying double tax on the income that the entity just paid on their behalf. And so those are the 3 general steps or features that you see in many states, and including Colorado. So Colorado passed an initial version of its SALT workaround. I kind of call this version 1.0 of the Colorado SALT workaround, and it had a couple of features that have carried through to today. And one of those features is that the entity is treated as a C Corp for purposes of Colorado income tax being imposed at the entity level. The tax is imposed on that income that would have been reported at the entity level by the outside individual partners, of course, accepting a non-resident owner's share of that entity's non-Colorado source income. So when that's done, for federal purposes, the arrangement is still treated as a pass-through entity, the flow-through of income to owners reduced by the full amount of the Colorado income tax paid by the entity at the entity level. And that is what avoids the $10,000 limitation that would have applied with the act. And so problem solved for federal purposes. And then under version 1.0 of the workaround, Colorado, through the statute, gave a subtraction to all the individual owners on the outside for the amount of income that was still reported to them for Colorado income tax purposes on their K-1. So you combine all these things, And that was how it worked under version 1.0. Another feature of 1.0 was that taxes paid by the entity or the owners to other states, for example, under other state SALT workarounds, could be utilized at the entity level to reduce the Colorado income tax paid by the entity. So the net effect of all this was that for Colorado purposes, the entity paid the income tax otherwise owed by the owners. The owners did not. The $10,000 cap is avoided for federal purposes, and no additional Colorado income tax is incurred within this structure. Under 1.0, this workaround was subject to an election by the entity on a year-to-year basis. And the election would have been binding on all the entity's owners, including the individuals that would receive this benefit. Version 1.0 was effective for tax years 2022 and later, and would be obviously removed if this act is reversed or something happens federally to remove the limit. One interesting feature of 1.0 that's important to tell you about is that under the statute, if the entity made the election and provided this benefit to its individual owners, the individual owners were required to add back any Section 199 Cap A federal small business deduction that they were otherwise entitled to. And interestingly, in reading the statute closely, this add back or this feature was not just for any small business deduction related to the entity itself. It appeared to apply to all Section 199 Cap A deductions that would have been available to the individual owners. That would have disappeared for Colorado income tax purposes. In enacting version 1.0 of the workaround, the Colorado legislature published some interesting information about the scope of this. They noted that it's generally only taxpayers with 150,000, individual taxpayers with over 150,000 of adjusted gross income would be impacted by the $10,000 cap. They told everyone that about 18% of Colorado taxpayers with business income have AGI of 150,000 or more. The original bill assumed that 18% of pass-through entities would make this election, and the net result, they expected that over 50,000 pass-through entities would make this election. Fast forward to today, this year they passed version 2.0 of the SALT workaround, and it has some of the same features, but it has some interesting and important differences as well. First of all, version 2.0 explicitly in the statute allows the entity to make the election retroactively for years after the act was passed, meaning that the entity could make the election for 2018, 19, and 2021. And I don't know for sure. We've kind of looked and poked around the country. So far, we think that Colorado is the only state that has adopted this feature so far. It's very interesting. Version 2.0 eliminates the subtraction that I described before for the ultimate flow-through entity income that still is allocated to the individual owners. It's different, and now it's provided to the owners in the form of a refundable credit. So if the entity pays Colorado tax on the income otherwise reportable by the individual owners, or if the entity has elected a SALT workaround in another state, all these things now come up to the individual owners as a credit from the entity that they need to take that credit on their individual income tax return. We don't know why they changed it from a subtraction related to the actual flow-through income and changed it to a credit, a refundable credit at the owner level. Some of you may know the answer to that better than I do, but we think it's because most all of the states that have implemented this workaround do this by providing a credit at the owner level. We think they just wanted to kind of conform with what all the other states were doing. As with version 1.0, the entity election under version 2.0 is binding on all the entity owners. This aspect of making a retroactive election raises a lot of weird and interesting questions. The statute says that if an entity wants to make the retroactive election for the benefit of its owners, it would do so only starting September 1, 2023, and it would have to do that between that date and July 1, 2024 by filing a special composite amended return for that year. Beyond that language and that detail, we just don't know what that looks like. There's been no publication of any draft composite return that would be used for this purpose. We don't know the other details about how this would work. I presume that it's not going to require money to flow from the individual owners, the taxes they paid before. I'm assuming that there's going to be no disgorgement and the entity would likely just get a credit for payment of the entity level tax based on the taxes previously paid by the individual owners. Another issue that arises from this is that if an entity were to make this election starting September of next year or before July of 2024, part of my practice is payroll tax and individual tax. And I know that federally, the statute of limitations for changing or amending a return is 3 years. And so far, without any guidance from the department, I don't know how that works. If I saw a John Maxfield or an Adam Cohen in the hallway, I would like to ask them, if an entity makes this election and the entity spits out a couple of hundred K-1s to all of its individual owners for the 2018 tax year, how are those owners going to make or file an amended federal income tax return that incorporates those K-1s from 2018? And I know that there's a raft of special rules for the statute of limitation for K-1s and income from a partnership, and maybe some of you have looked at this and know an easy answer, but we don't know how that's going to work, and we don't know how the individuals for an entity that makes a retroactive election, how they're going to file those returns and claim this benefit. And hopefully we'll find out soon. Other points for the retroactive election is that when the IRS put out its Notice 2020-75 to basically bless this type of SALT workaround, it didn't talk about retroactive SALT workarounds for prior years. And so it would be advisable to keep an eye on whether the IRS does or does not say anything about the retroactive version of this. And then what I mentioned earlier is still there. The adverse effect on the partner's Section 199 Cap A small business deduction continues. And let me emphasize what I said before. It does not appear limited to Section 199 Cap A deduction with respect to this entity's income. It looks like it's a trade-off where every individual for an entity that makes this election would have to give up all of their otherwise available 199 Cap A deduction from any source whatsoever, and they would have to add that back for Colorado income tax purposes. And we know that there's some other provisions out there in the Colorado statutes that would limit the 199 Cap A deduction if you're at certain income levels or you fit certain circumstances. But we believe that for any entity that wants to make this deduction, it would have to balance and weigh the potential detriment to the individual partners on the outside because they would not be able to get the benefit of the 199A Cap A deduction from their other sources, including this entity itself. Another important point on this is that the Department of Revenue has put out guidance recently saying, wait, we don't expect and require estimated tax payments from the entity that will make an election under this workaround. We're only going to require estimated tax payments starting in 2023. But my colleague Mark Kozik has written me literally 4 emails on this and 3 texts, not kidding. He wants me to remind all of you that even though there's this nice rule that no estimated payments are required until next year, if your entity wants to make this deduction, make this election for 2022, it probably needs to pay the tax in the calendar year to achieve the deduction at the entity level that everyone wants out of this structure. So I am definitely supposed to remind you that this is an issue to talk about with your tax preparer or internally as to whether, if you intend to make the 2022 election, it may be very important to actually pay the tax before the end of the year to get the benefit for all your individual partners. Other details about the version 2.0 would be that it's the Colorado corporate income tax rate of 4.55% that applies at the entity level. And then, as mentioned before, that tax would apply to each owner's share of its Colorado source income if it's a non-resident individual owner. And of course, if you are a Colorado resident owner, the tax would be paid on the owner's overall entire share of the pass-through entity's income without regard to Colorado sourcing. As mentioned before, there is a credit if the entity happens to go out and elect a SALT workaround and pay tax to a California or some other state. That is no longer reduces the Colorado income tax paid at the entity level. That is reported out, and that now becomes a refundable credit at the partner level. So that is kind of an overview of the SALT workaround. And then, yes, there's one question?
Rules apply equally to partnerships or S corps that are strictly hold investment income like interest, dividends, and cap gains, or does it have to be business income?
I think it applies to all pass-through entities or entities that are treated as pass-through entities for federal income tax purposes. And to answer your question, I'm not aware of any specific limit in the statute so far based on the status that you described. Other questions?
To follow up, that's I think our biggest issue is if it is a deduction, what is it a deduction against? Is it a deduction against interest income, dividend income, capital gains, or does it fall into administrative, like tax prep, that's not deductible? That really confuses me, and I'll give you another example. $3 or $4 million in royalties in a partnership, all Colorado sourced. Where do you put the deduction on the partnership return?
So Gail, I think that's an important question, and I think that is more for an Adam or a John Maxfield. And I don't know, as a state practitioner, all the intricacies of how the deductions are taken at the partnership level for taxes, like a new tax like this or other expenses, I don't know. But I think that's a very good question, and that's something that's going to have to be resolved.
I might share with the group what I know about some very high-level advice given from a big accounting firm to an entity in California. Could I have about half a minute?
Absolutely. That's what this is for.
It's the, not royalties, but it's the investment partnership. They're putting the fee on the front of the tax return as a trader business deduction. And so it's going to flow to Schedule K on line 1. And my question is, since we all know that everything has to fall into some kind of a category like active, passive, it has to be passive in my mind because you can't be active. And they're taking the position, since this was the disposition of a portion of an activity within that partnership, that it becomes active, or it becomes non-passive because of that disposition. I think that's a hooky conclusion, but that's what I'm aware of.
I think next year, when you do this update, if you cover the same topic again, this would really be a good thing to focus in on. It's really a confusing issue, how in the world you're converting something that's not a business deduction into a business deduction.
Well, I mean, in CPE that we've taken either from Mark Vogel, or if it's in an investment partnership, it's a non-deductible expense.
Right.
So it doesn't have any impact. There's no sense in making the election because you're not going to be able to reduce the income.
Could you repeat that, please? I'm sorry.
I said if you take Mark Vogel's class on it, it's
do a lot.
an investment partnership. it's a non-deductible expense, and so you don't get any benefit from it.
I understand that position very clearly.
The reason where I'm coming from with this question to begin with is when this first came up on the East Coast states, or like California, New York, New Jersey, they were trying to make an equality for business owners, not so much make an equality for family investment partnerships. It doesn't seem to me like, I mean, I'm a tax preparer also, it doesn't seem fair in the tax scheme to allow you a business deduction when you don't have business income.
And maybe that question is answered by applying the federal rules about what is deductible at the partnership level, and will Colorado adhere to that or not? I absolutely agree that this is an important issue, and next year, maybe some component of the federal presentations could tie this in and give some better, and updated information about how this is going to work. Right now, I don't know how to answer that question.
Thanks for allowing the open discussion here.
Sure.
What other
There's another
people-
question from the back.
Sorry, just one more. On your previous slide, there was the rate was showing a 4.55%, I believe, or maybe the one prior to that. Oh, there it is. And so is my understanding the rate that got passed in November is 4.4, and is that for 2022?
I don't know the answer to that question. I prepared this slide with Mark, and the 4.55% might be adjusted according to what you just said.
Okay.
I'm seeing some nodding around the room. Yes.
In calculating the tax, are you allowed to look at upper tier entities that might be exempt in making a modification to reduce deduction, but then you'd run into allocation issues?
I don't know how to answer that question.
Okay.
It's one of those things, as Bob Keating would say, it just provokes questions in every other area, and some of them I'm facile and knowledgeable about, and what you're asking about, I would have no idea how to answer that. Okay, so moving on, past the SALT workaround, we had a case that was issued right after Thanksgiving, the Anschutz versus Colorado Department of Revenue case. It was a Court of Appeals decision. And let me just tell you a little bit about this case because it's interesting. You all know the rule that for purposes of calculating Colorado taxable income, the baseline is federal taxable income as determined pursuant to Section 63 of the code, the Internal Revenue Code, subject to certain Colorado modifications, either additions or subtractions. And then in our statutes, the definition of Internal Revenue Code for that purpose, it means the provisions of the Federal Internal Revenue Code of 1986 as amended, and other provisions of the laws of the U.S. relating to federal income taxes as the same may become effective at any time or from time to time for the taxable year. And the Colorado statutes give a little bit more flavor about that, but what happened in this case is that in March 2020, Congress passed the CARES Act. And again, that's federal tax law, and I don't know all the nuances of what the CARES Act did or didn't do, but one of the things it did is that there was a limitation on taking certain business losses for 2018 through 2020. And the CARES Act took away that limit and said you can actually exceed the limit that previously existed, and you can file an amended federal income tax return to claim that benefit. And so the Department of Revenue, when it saw this activity in Congress, it passed an emergency regulation saying, we don't like that at all. We feel that rules need to be in place during the tax year at issue. And so we're going to impose a regulation or rule that if an update is not in place by literally the end of that tax year for Colorado purposes, you cannot gain any benefit from that change in the federal law. You're frozen. It's frozen at the end of the year. And then, interestingly, the Colorado legislature also passed some provisions saying that for certain periods, if you got this benefit under the CARES Act, you had to add back that benefit for Colorado income tax purposes. However, that legislation was limited to 2020 only, leaving open the door for taxpayers to take the benefit in Colorado for 2018 and 19. And that is what the taxpayers did. They amended their 2018 personal income tax return to claim a refund that arose by removing the limitation on that business loss deduction, which is what the CARES Act did on a federal basis. The Department of Revenue predictably threw up their hands. They said, no, absolutely not. Your 2018 Colorado income tax return cannot be impacted by anything that took place federally after 2018. So you, taxpayers, are out of luck. They took the case in front of a Colorado district court, and that district court is a little frustrating, and I don't mean to criticize the district court, but they applied the concept of deference to the Department of Revenue. They thought the statutory provision that I read to you earlier was somehow ambiguous. They looked at the legislation that the Colorado passed restricting the benefit for 2020, and they said, put all that in the hopper. We're going to agree with the department, and no refund to you, Mr. and Mrs. Anschutz. So the Court of Appeals took a look at all this, and you heard the definition of the code that I articulated earlier. It says enactments of changes to the federal tax laws as enacted from time to time or at any time for the taxable year, not just in a taxable year. So from our standpoint, a practitioner standpoint, the appeals court reached the right decision. It didn't make sense to a lot of us that they were trying to restrict this and going through so much effort. So the Court of Appeals basically said the statute is clear, and Department of Revenue, yes, you're entitled to make regulations and rules, but they have to be consistent with the statute. So we are hereby allowing this refund to the taxpayers. And now, what is the impact of this on our clients? Mark and I have discussed that we would want to review the client's Colorado income taxes for 18 and 19 to see if there's any possible refund opportunities related to the CARES Act enacted in 2020. So we know from this case that there's the expanded excess business loss for individuals. We know there's expanded NOLs for individuals as well. And we know that there's an expanded business interest deduction available under the CARES Act as well. So this case opens up the door to the premise that you could go back, refile the client's returns for 2018 and 19, and then obtain a Colorado refund as well.
You can just wrap it up in the next minute or so, that'd be great.
Sure. Okay.
Thanks, Arthur.
So we're out of time because of the SALT workaround. So there's other slides in the deck. I was going to talk about the Colorado retail delivery fee, which some clients are very upset and exercised about because, of course, Colorado is supposed to be simplifying state and local sales tax compliance. And now we have the retail delivery fee and all the components of that. If anyone has any questions about that retail delivery fee, I can answer them at the end of this conference. I was also going to talk about the new sales tax sourcing rules that are applicable now in Colorado, but I will halt it at there. Thank you.
All right, so we're going to talk a little bit about tax controversy and tax litigation, and this is more a little bit of a panel approach that we're doing here. So my name is Bill Colgan, and I'm in charge of the tax controversy and litigation subgroup here at Holland Hart, and we have 9 attorneys, or 9 timekeepers, 8 attorneys, 1 project specialist that is part of our subgroup, and we do federal issues mostly all throughout the country, all sorts of industries, all sorts of issues, and both a combination of like administrative practice kind of stuff, IRS appeals, examinations, even some planning related stuff where we might weigh in, all the way to litigation at any level, any court. We just had an active case right now that's had stuff happening yesterday in DC District Court in Washington, DC. And just a note on the firm, so a lot of us have come from other places, and a lot of us are former big law coastal kind of firms. But one thing that is really significant to us here is that we have 54 tax attorneys at Holland Hart. So, I mean, not only is that big for Colorado and the Rocky Mountain West, that is big for most of the big coastal firms. And it's a very diversified practice, which is great for us because, and I won't be speaking on behalf of the other members of the panel, but for me, what I rely on is experts, subject matter experts to team with on a litigation. And so for us to have such a diverse expertise, and if we happen to be, working on a SALT issue, to have somebody like Arthur to talk to, or Adam, and just so many people, it's just incredibly valuable. We also have about 15 other timekeepers. So we have some CPAs, and I mentioned on our team we have a project manager, and so we're really kind of on the cutting edge nationally on some of the approaches to how a tax practice in a law firm can work and can work efficiently with timekeepers. But let me jump to introduction of our team. So on the far end of the table there is Sue Combs. She's a partner in our group. And she does tax controversy and tax litigation, mostly at the federal level, and mostly corporate taxpayers, although we kind of see a lot of everything. And we do a lot, Sue does a lot in the area of transfer pricing, intellectual property tax, some employment tax stuff, and those sort of things. She brings more than 20 years of litigation experience to our team, and including in the U.S. Tax Court, where we spend a lot of time. She's an active member of the administrative practice section of the American Bar Association, which is a national organization in the tax section. She's a regular speaker, and if you follow the tax press regularly, you'll see her name pop up. She's a regular commentator and somebody that the reporters go to when they have questions and want comments. And she formerly was a clerk at the Seventh Circuit Court of Appeals, which is a very prestigious circuit. And Sue is based in our Jackson Hole office, and she's also the managing partner of that office.
Somebody has to be in Jackson.
And then immediately to my right is Jennifer Benda, partner in our subgroup as well. And Jen has a very unique and very deep expertise in what we do. She was a CPA in Big Four before becoming a lawyer, seeing the light and becoming a lawyer. So she's a CPA as well as a very successful tax attorney. So while she's in our subgroup, she also has substantive expertise in tax as well, apart from just the procedural and administrative and controversy stuff we deal with. Her practice is very broad, a lot of federal stuff, but also some SALT stuff as well. And she's a national thought leader on cannabis tax issues, which cannabis tax, that whole world, I think has shifted from initially it was a lot of compliance-related issues and controversies around compliance. It has shifted into, because now there are consolidated companies with big tax issues that are like tax accounting issues. There's a couple of pending matters that Jen has that are very important, but also could affect other taxpayers outside of cannabis. And so the issues are evolving outside of just cannabis-specific compliance issues. And it's become a hot area, very hot area for all of us. And Jen's also active in the ABA taxation section and speaks locally, nationally, writes in the tax press, and then is also quoted in the tax press. And then Tammy Kotzker, who is in the middle, recently is our most recent team member, and boy, did we snag an IRS insider. Tammy was 17 years with Chief Counsel, and progressively rose to very important management levels within IRS counsel, and was associate area counsel when she left, and which gave her visibility to lots of things that happened in chief counsel. She managed a lot of that stuff, was on initiatives, national initiatives, and that sort of thing. And I can't really capture all that Tammy brings to the table, but we are sure benefiting from it, as are our clients. She was also a special United States attorney, which is a designation that can happen with IRS lawyers. It doesn't happen to all of them, to where she could appear in federal court and bankruptcy court here in Denver. And she, her integration into our practice is she just does a lot of what we do now, elevated our game. So with that, I'll turn it over to Sue to jump into the presentation.
Great. Thank you, Bill. Thank you, everybody, for joining us today. It's a pleasure to see you and to be able to speak with you. I'm going to kick things off by talking about a case called In Re Grand Jury. And this case has enormous potential implications for the attorney-client privilege, which will also affect the privilege allowed by Section 7525, the tax advisor privilege. This case will be heard by the United States Supreme Court on January 6th. So we are eagerly awaiting the Supreme Court's ruling in this case and decision. It's being very closely followed by the tax press and the tax attorney bar, as well as tax advisors. To give you a bit of background on the attorney-client privilege before we dive into the case, the attorney-client privilege is very old. It's a very strong principle developed through case law, and it's not a statutory provision. It is a protection for clients and taxpayers when they talk to attorney to allow for the free flow of information. The thought behind that being the free flow of information will allow attorneys to help clients comply with the law, which is beneficial for the greater society. But limits on the attorney-client privilege and the tax practitioner privilege are not new. So for example, communication has to be kept confidential with your attorney in order for it to be privileged. And this case is dealing with the outer bounds of the attorney-client privilege when a communication has multiple purposes. So for example, if the purpose of an attorney-client privilege, it won't surprise you, has to be for the purpose of seeking legal advice or giving legal advice. And this case involves situations where the advice being requested is legal advice, but it has an intermingling of just a business purpose, a corporate reason for seeking the advice. An example would be a corporate investigation. Another example in the tax context is providing tax advice in connection with the preparation of a tax return, which is a very common setting. So In Re Grand Jury is dealing with these multi-purpose communications. It's a decision out of the Ninth Circuit Court of Appeals, and it sets up essentially a three-circuit split for what test applies so that you can know whether a communication you're having with a client is going to be protected from disclosure from the government or not. And in this case, the Ninth Circuit Court of Appeals decided that a court must identify the purposes of a communication, and then that court must weigh what was the relative importance of the different purposes. So if there's a legal purpose, how does that weigh against the business reasons behind this communication? So it requires a court to have a subjective decision-making process about what they, years later, looking at this communication, believe was the most important purpose for it. The circuit split is created by, there is a Seventh Circuit opinion that has actually been on the books for a long time, and it reflects the government's position in this case, that if you have a document that is prepared for the purpose of tax returns, then there's no privilege whatsoever. And in this In Re Grand Jury, the law firm was actually advising the client on expatriation, legal advice, as well as preparing tax returns on that issue. and the IRS conducted a criminal investigation and asked the law firm for the documents. The law firm refused based on attorney-client privilege. And if they had been in the Seventh Circuit, the test would have been much stricter in terms of whether the privilege applied. In the DC circuit, had they been in that circuit, they would have had a much more friendly and protective standard guiding the determination of privilege, and that would have been, was legal advice a primary purpose? And that, what does that mean? It means that the one of the significant purposes for the communication was seeking legal advice. It doesn't require the court to weigh which one was the most important. And so in the Ninth Circuit, you have the primary purpose. What is the one and only primary purpose? DC, was it a primary purpose? And then in Seventh Circuit, we have language that is quite restrictive.
And Sue, could I just jump in? And going back to the conversation we just had about the SALT workaround. So, you can see that there are different perspectives on that. And if you go to an Adam and you go to Adam and ask the question at the federal level, how should we structure things? Is there a way we can structure it so it's a business deduction, whatever, those kind of structuring? The answers aren't clear. And so typically what Adam might respond with is well, here's one perspective, gives you a bad answer. Here's another perspective, gives you a good answer, and it's unclear. But in terms of how you structure it, here's some thoughts. That's probably a mixed issue. Or you have the question of how do we treat it on the tax return? That clearly is at the core of the mixed question here. How the Supreme Court decides this case is going to make one scenario where the IRS can ask for it in an examination, and you have to give it over. And that means Adam's email. They could potentially call up Adam and interview him about what he said. The other scenario, which I think all of us think is the right answer, is going to be it's going to be privileged and protected. But that's just like a real world example right here, right now. It's something we're confronted with every day. And so it's a very important decision.
Absolutely.
All right.
One thing before we go, just a quick note on, so what does this mean for those of us who provide advice? Some very high level ideas are at this point to avoid commingling business communications that have business purpose and legal purpose. That's the safest route, quite frankly, given the Seventh Circuit standard that we don't know where the Supreme Court is going to go.
Well, and Sue, I think we've, kind of taken advantage, or our way of operating is assuming there is a way to kind of, if you're preparing a tax return, have some privileged communications along the way. I think if this case goes the wrong way, that's going to be harder. And we're going to have to we'll have to see if there's some sort of structure where that can happen. But it makes me very concerned that anything tangentially related to a preparation of a tax return, even if it didn't wind up on the tax return, let's say you got an opinion and you didn't follow it. Well, that didn't wind up on the tax return, but is that still protected by privilege? I mean, that's a really troubling scenario.
And it gets very acute because the IRS, the way they ask the question in an IDR is they say, give us this document, right, or whatever. All communications about this thing. And we say it's privileged, and they say, okay, well, we want a privilege log. And one of the elements of a privilege log is we have to state the purpose of the communication. And you're not going to get one of us to sign anything or submit anything to the government if there's multiple purposes. We're not going to just say, oh, it's a legal purpose. We're going to put them all down because we have an ethical obligation about misrepresentations. And so that's when it's going to immediately, before you have like a battle in court or anything like that, it's going to come up right at that moment. And will be challenging.
Okay.
So we're going to shift to Tammy and a topic that is, of course, in the press on a daily basis and has been, quite frankly, just for different reasons for many, many months. It's at the forefront of the tax world right now, in the tax controversy world, crypto.
So yes, it has been at the forefront of the news for the last month because of, Sam Bankman-Fried. I believe he was just indicted on Monday. FTX, the collapse, I think it was 32 billion that he took of his client's money, which Jen's going to weigh in on whether you can possibly, if your client will be eligible for a theft loss deduction. That's up in the air, but it is on everyone's mind, and it's certainly on the IRS's mind. Whereas the SEC and the CFTC, they're worried about protecting consumers. The IRS, they think that there's a lot of fraud out there. They think there's a lot of crime out there that's being taken advantage of over the net, and so they're looking to crack down on that. So just in October, they announced the creation of a new digital asset project office. Exactly what that means, I don't know, but there is now a new website that all the guidance that the IRS has released on crypto is now gathered together on that. I think just in October, November, the definition of digital asset was expanded on the Form 1040 and instructions were just released. So you'll see that it greatly expands the definition of a virtual currency, which was the standard in 2021, to now 2022, it'll be a digital asset. So that's expanded to contemplate NFTs, which has been another hot topic. It also specifically says, not only did you receive or dispose of a digital asset, did you receive as compensation, award, or a reward? So you can imagine that's quite broader than in 2021. And why is that relevant? There's currently no penalties if you answer that question wrong, but I would hate to be in a position where you answered no to that question and then your client inadvertently didn't report the sale of Bitcoin or maybe even the conversion of Bitcoin to ETH or one of these transactions that is a taxable transaction.
Well, and the IRS is taking from the foreign bank account playbook there by putting that box on the tax returns. And so what they did, and we'll talk about FBARs in a minute, but on the FBAR cases, if you checked no on Schedule B to that, do you have a foreign bank account, they're using that as evidence that you willfully avoided tax, especially when you had unreported income. So that takes your potentially civil situation to a very easy criminal case for the IRS. And so I think they teed it up really well. And they teed it up during years where the crypto was going up. Now crypto's going down. Things are changing a little. We have these potential fraud situations. I just think we're going to see the same, I think, pattern of enforcement happen there.
Yeah, and on that note, I think I just looked, Bitcoin was trading around $12,000, and at the highest point last year, it was at $69,000. So it's certainly crashed, but there were a lot of gains to be made in prior years. And then just on that note, so before I came here, the last couple of years I was with the IRS, I was doing a lot of offshore compliance work in FBAR cases. And you can look at the cases, all the instances where willful FBAR penalties were asserted, not all, but I would say the majority. On the 1040, the individual checked, no, I did not have, a foreign bank account or a foreign interest in a financial asset. And it was interesting. A lot of times we would go interview the CPAs, the preparers, and their answers were always very mixed. Like, did you have this discussion with your client? I don't know, maybe, of course I did. It was all across the board. And I don't know if they weren't taking it seriously, but the IRS certainly lynched onto that. DOJ did. If you checked no and you had accounts offshore, they willful. That was their conclusion. Again, whether it was inadvertent. So I think you're going to see a similar pattern, like Jen said, and with the cryptocurrency.
But somebody else prepared the tax return. I just signed it. Is that a defense?
People have tried that one.
Yeah, and on the crypto front, those of us that just see it mostly from the news reports, you get this sense that it's you can't trace it and all this stuff, and the tracing tools that now exist, it's just not. People should not for a second think transactions can't be traced.
Well, and that's where John Doe comes in.
Yeah, so on that note, so when I left the IRS, they were just getting access to these tracing tools, but now they have state-of-the-art tracing tools they're partnering with third parties to use their software. That is not an issue. I mean, if you think of a case involving cash or like bank deposits, I mean, it's the same thing. As soon as they can get the public key, which is basically like the person who would sign on the account, once they can figure that out, the internet will basically, the blockchain will give them access to every transaction that's happened. So it's very traceable. And the John Doe summons, that is their key to getting the public keys. So they got the software now. Now they're using the John Doe summons to get everyone's identity. So this started back in 2018, and I'm sure you guys all heard about the Coinbase summons. That was very successful. I think it generated, I'm gonna just throw a number out there, it was about 15,000 names of people that had transactions over $20,000 in like a certain time frame. They issued 2 more, I think last year, for Circle and Kraken. And then just this year, they issued another 2 John Doe summons on Ox Labs and then MF Sofra Bank. And why is that relevant? This feels eerily familiar to the Swiss banks' John Doe summons that were being issued, 10, 15 years ago, that really cracked open the Swiss banking laws. So it seems very similar. And just for those of you guys that, a John Doe summons, it's very different than your typical IRS summons that you may get on your taxpayer or on a third party. In a John Doe summons, the IRS doesn't know the name of the people they're looking for. They have an idea that there's some fraud or non-compliance going on. And it's pretty hard for them to get. They have to go into district court, get a judge to sign off on it. These investigations that lead up to that filing in court take years. And then they have to have evidence that there's actually non-compliance. So it's not willy-nilly. It's hard for them to get. But it seems like they're getting them pretty easily and they're increasing. I think I read from the last 2 this year, they've already gotten 85,000 names. So that's quite a bit of taxpayer names. And I think they'll only just keep doing that.
Right.
Yeah, and as a side note, we've seen a recent ramp up of activity of issuing John Doe summonses to law firms and advisors who are involved with tax preparation, which that's been a sort of a recent trend, and the government's been successful in some cases. So
moving on to a related topic of FBARs, I think we're all familiar with the enforcement that's gone on there. We've spent many years with the IRS getting answers to John Doe summonses, going to the foreign banks, getting everyone into compliance. We still have, people who haven't properly filed foreign bank account forms or foreign trust forms, 3520s, 5471s. There's all sorts of weird issues that come up with, foreign retirement plans, and are those treated as trusts? And one of the issues that we've worked through over the years is when a taxpayer is identified as failing to comply with the FBAR requirements, there's a determination whether they might have been willful or not willful. Those are the things we consider when we're recommending how someone goes through a voluntary disclosure process. And generally, when someone's non-willful, what would happen was there would be a set penalty per year because one form was not filed every year. But we have a case in front of the Supreme Court that Sue is going to talk about where the IRS is taking the position that because there were, I think, hundreds of accounts that should have been reported on this FBAR, that the penalty is not based on failure to file one form, but failure to report each account. And that obviously changes the landscape a lot because when we talk to people about voluntary disclosures, we often say, well, if it's non-willful, the IRS has 6 years that they can go back and assert a maximum 10% penalty, like that's your maximum harm. This case potentially changes that quite significantly, especially for someone who has a lot of accounts.
Right, so the case is Bittner, and this comes out of the Fifth Circuit Court of Appeals. And there's actually a circuit split on this case as well, going back to our friend, the Ninth Circuit Court of Appeals that you heard about with Henry Grand Jury. This case was heard by the United States Supreme Court on November 2. We have some really exciting tax cases right now. Historically, I think the Supreme Court doesn't take as many tax cases, but we've got some really significant decisions that we're waiting on. So really exciting to hear what the highest court will decide. This case, as Jen alluded to, it's a very discrete question. Does the Bank Secrecy Act, which requires the FBAR reporting, if you fail to report an account on the annual form, there's only one form, but you're supposed to list each foreign bank and financial account. So is the violation to which the penalty attaches just the failure to file the form? So you have one penalty, or is it every single account that should have been listed on that form? So in the Bittner case, the difference between is it a per form approach or a per account approach was per form, it was subject to the $50,000 statutory cap. Per account, the penalty that the IRS is asserting is $2.7 million. So it's vast and significant difference depending on how the Supreme Court decides to interpret this statute. So this case is full of very esoteric and academic statutory interpretation principles, which the Supreme Court is known for tackling. The arguments in the case focused on, like I said, the statutory language. There's nothing in the statute that says per account. But it also doesn't say per form. And the Supreme Court was looking at the language of the statute and the specific provision as well as the language surrounding it. Petitioner's argument is it's a per form, so capped at $50,000. Government's position was it's per account. I won't go through each of these specific arguments, but know that it was a really statutory interpretation heavy discussion. The equities actually came into play. I listened to the Supreme Court arguments, and the justices did appear to me to be divided on the appropriate outcome in this case. I anticipate, can't be sure that we'll have a split decision here. And the equities seem to be a very important part in addition to the statutory text. So the equities in favor of the petitioner's argument is the IRS hasn't notified people that this requirement exists. And so it's really going to ensnare a large number of taxpayers such as immigrants and other taxpayers who may not be as sophisticated about US tax laws into this penalty, and it is draconian to say it should be, so for example, a penalty on each account versus just the per form penalty is just too extreme of a penalty.
One of the equities that we always argued was sometimes a $10,000 penalty would eradicate accounts. So, if you think about, well, the form is required when you have over $10,000 in these accounts. What if you have a bunch of accounts that are well under $10,000 and you have a $10,000 penalty for failure to report that account? That's where these cases evolved into kind of excessive fine and penalty cases and things like that.
Yep. And interestingly, the equities that Jen just talked about, those were persuasive to Justice Jackson, asked a lot of questions along those lines and clearly signaled her view that it is a per form approach. Justice Thomas and Justice Gorsuch were appearing to be siding with Justice Jackson and were asking questions along the lines of, well, the statute doesn't say, per account, for example. On the other hand, Justice Sotomayor also had an equitable argument. And her equitable argument was, well, if you have incredibly wealthy individuals who are failing to disclose these financial accounts, then you are contravening the purpose of this reporting obligation, which after 9/11 there was some legislation put in place that the focus is on terrorism. So are these financial accounts being used to fund terrorism and other criminal activity? So there's equities on both sides, to be seen where the justices come out.
I'm curious to get Tammy's opinion on one thing. We have these mitigation procedures in the Internal Revenue Manual that had some pretty clear guidelines where we wouldn't have expected to see a $2.7 million penalty under these facts. So what happened here?
Well, and I don't know if you ever have one of these cases, you definitely want to go into the IRM or Google mitigation, because while it's, discretionary, it is an IRM and the agents are required to follow it. But the mitigation procedures basically provide, depending on where you fall in certain levels, it caps the non-willful penalty and the willful. But in this case, I believe the mitigation, if you have total accounts over 250,000, then it was per se $10,000 per account that was unreported.
Okay.
So if it's under 250,000, I think the cap is much lower, maybe even 5,000 or 10,000 per year. So just interesting note on just FBAR in general, on these non-willful penalties, a lot of the accounts had zero balance, because it was just, you only had to report it if it was at greater than $10,000 at any point in the year. So theoretically, the IRS was supposed to back out, like if you had transfers in accounts, they should take that into consideration. I don't know that always happened, but you can see how it can be pretty egregious if you had, that same $10,000 being transferred multiple accounts, and you had 9 accounts with zero balance. Well, they would still hit you up with that $10,000 per account penalty.
That's where the accountants in the room become our best friends to help us figure out all these things to try to mitigate these penalties.
And this stuff all started with the amnesty program on FBARs in 2010, I think. So what was it? 2009, wow. So we've been dealing, and no offense, Tammy, the service was not prepared when the amnesty program was issued, because this was one of the issues that we had to assess willfulness right off the bat. We had to tell our clients, like, what's their penalty exposure on this? Because clients are deciding whether to come in or just take their chances. So they come in and say, what's our exposure? And we'd be like, well, it's not clear. And so, there were years of pressing for guidance, and then positions were staked out. And what you're seeing now on these penalty cases, the reason we're talking about this is because it's still live for a lot of people. And the other thing that's really important about this case and others, and even though the case Arthur was talking about, is we are usually, our disputes, like one of the most common characteristics of our litigations, even the big ticket litigations that we do involving millions of dollars, is we're looking at a provision and trying to interpret it one way or another. And you all are doing that, for those of you that are pre-tax return or work in the deal world. If you look at a provision and it's unclear, and we talked about one today, what we usually try to default to, given the trend of judges in the country moving more towards being tight on reading the code and the regs and not deviating, we usually default to that kind of bias, because we have a lot of success in the litigations by saying plain meaning, et cetera. But when you see a case like this and you have both sides, the press kind of portrays it as partisan sides in the Supreme Court, but really what's driving a lot of it is different judicial philosophies, drastically different judicial philosophies. And so, it makes it really difficult for us, and when we see a case like this, when they're arguing the equities, because how do we put that into our analysis? And it's going to be very interesting to see what comes out of it. All right, I think we're, Tammy, you're up again, catching tax cheats.
Hey, this is an issue that's near and dear to my heart. I think you guys probably all are getting like the sense that the pendulum is definitely swinging with the IRS getting this increased funding of $80 billion, that compliance and enforcement is definitely going to swing the other way. I was at the IRS for 17 years, so I saw when compliance and enforcement was very heavy. And then I think over the last 5 to 10 years with the cuts in the budget of the IRS and chief counsel, they were doing the best they could with what they had. And I will tell you, they got very good at being efficient. So imagine now what they're going to do with $80 billion. So this is to scare the heck out of you, because it should scare us all a little bit. At council the last couple of years I was there, you had like 100 cases on your plate. It was basically like, do what you can. So I think things were sliding by. Just a warning, you may not be getting as good a favorable settlements going forward. So with that said, I just wanted to kind of highlight some of the things the IRS has kind of said that they're increasing enforcement as far as fraud. Their strategic plan specifically says there'll be an increased emphasis on high net worth individuals. They just announced the formation of the Joint Strategic Emergent Issues Team. They call it JSIT. What does that mean? Well, that means they have a group task force now of LB&I, SB, criminal counsel that are all working together to identify topics and transactions before they become abusive. So they're hoping to be proactive in identifying the next syndicated conservation easements or captive. And what are they going to use for that? I don't know, but they've kind of signaled it could be social media, informants, attending seminars, where we're all presenting on the next big thing. So they're really trying to get ahead of it. The IRS CI last year identified $32 billion in fraud, and that was 3 times the amount in 2021. I think a lot of that is because of the creation of the Office of Fraud Enforcement. It's relatively new, I think within the last 2 years. And this office, their focus is on training the agents and collection on identifying fraud. In the past, you would get cases that they kind of checked the boxes of fraud. Do you have it? They weren't well developed. They thought that anyone that was driving extravagant cars or taking crazy vacations was fraudulent. And I think they were losing in court, and council was rejecting those. CI was rejecting those. So now they have this new Office of Fraud Enforcement, and they're really working on teaching those agents how to develop those cases.
We have to remember, we have a commissioner that did what we do for most of his career, and he's leaving, but I've seen just kind of a dramatic shift in, like Tammy said, them becoming more efficient, them being able to pick up on transactions sooner. It used to be we could outrun the statute of limitations. I don't think that's the case anymore. Although there is one transaction I've been hearing about for years that I think it took them 4 or 5 years to finally identify. That's the monetized installment sale, if anyone's ever looked at those. One guy nodding his head. So they finally identified that one as something potentially abusive. And the other things we've been hearing from the IRS at conferences and over the years, especially when cryptocurrency became a focus of enforcement, is all these people who are cryptocurrency millionaires are on YouTube talking about how to make $1 million on cryptocurrency. And so the IRS goes out there and looks at YouTube and looks at Facebook and looks at all these ways people flash their wealth, and they're going to target people based on gathering that information. So there's a lot of foolish activities that people can engage in to jeopardize the chance of criminal prosecution. And those, I'm assuming those aren't our day-to-day clients, but those are the people that are going to have some real problems here. And I've been asked recently, what's the upside of all this new enforcement? And what I tell people is, if you're complying, you can have some comfort that the people that you're bitter about who aren't complying, who are getting away with things, are maybe going to get away with things a little less. Or maybe a lot less. It all kind of remains to be seen. But I think this is good for us as people who try to guide people to do the right thing, because a lot of people play the audit lottery. A lot of people are like, what's it going to take to catch me? I mean, I'm kind of amazed with what people can get away with. But I think that this makes all our jobs, it makes those conversations a little bit easier when we have examples out there that we can point to. And one of the areas we have been seeing some questionable behavior is our next topic, which is employee retention credit. So I think as a lot of people know, the employee retention credit was part of all the COVID tax provisions that were put into place when the pandemic hit. And it was very interesting because there was kind of a pretty broad statute. People looked at it, maybe someone didn't have a significant decline in gross receipts, but there's also this pretty broad language of, did you have a partial suspension of operations? And what happened was the original law was passed in March 2020. In December 2020, they were realizing people hadn't been claiming the credit. There was actually a public awareness campaign built into the extension of the ERC, which is really kind of interesting. Them saying, we want people to take advantage of this, and we realize that enough people haven't. And then in 2021, March of 2021, the IRS issued a notice that gave us some concrete examples of how do you show a partial suspension of operations. And what has happened since then is that this whole cottage industry of ERC mills, let's call them, has cropped up. I've seen commercials during football games for getrefunds.com. And we've had a lot of clients come to us because someone has approached them. They want to be sure that it qualifies, or because there are really some exorbitant fees being charged, which the most egregious contract that I saw said, okay, you're going to get your refund. The refund's going to come to us. We're going to take our fee out of that refund, give you the rest. And by the way, if the IRS comes back and audits you, your fee to us doesn't change. So there's really this problematic regime out there of people who are being very aggressive. We've seen situations where the client is given a form, did this happen to you? You check a box, they're like, oh, you qualify, here's how it goes. And when we look below the surface, we're seeing there's no documentation, there's no substantiation of qualifying for these things. And I think the clients that are coming to us are smart in wanting to make sure that it gets done right. And so I'll let Tammy talk about what we're seeing the IRS's reaction to this, because they're very aware of this. They're holding back refunds. They're jumping on it. And this is kind of a sign of the IRS is getting faster and more nimble at stopping these things, because I know in the past, especially with like earned income credit and things like that, they've had a lot of scrutiny for issuing refunds that they never should have issued. And so there are a lot of flags that they're able to put on accounts now when there's refunds to make sure that they stop the money from going out the door if there's any sign that something might be off.
Well, I think my favorite quote in dealing with this topic was, we were talking to a client and, he's telling us, I get this $1.5 million refund. And we're like, okay, did they do any analysis? Well, they must be a reputable company. They gave a presentation at some conference he was at. And we're like, well, of course. And you look up this company, they just arose in like the last 2 years, and they probably are going to go out of business in the next 2 years. So are they going to be around to defend, these audits? Probably not. So, some of the most egregious things that we've seen, I think Jen kind of mentioned, but, where they just have the client like check, did you experience a partial suspension? Yes, and then that was the end of the analysis, and it was literally a one-page analysis. I don't think that's gonna save the day in the audit, and that's a pretty clear-cut example. I think harder area, there's a bunch of gray in this area, because the only guidance out there right now are a couple IRS notices and these FAQs, and that's it, right? There's no other guidance for us to hang our hat on. So I think there's gonna be a lot of gray situations. We're seeing that with our clients, and what can you do? I think you gotta document it, right? You better pull as much of the relevant information. A lot of this has to do with like public health orders that impose COVID restrictions. Gather that information. It may not be available in 2 years. Document it. Document why your client's taking this position. Maybe it is aggressive, but I think when you're relying on FAQs that are there's just not a lot of guidance. I think that that's the best you can do for your client to avoid a penalty. And as you can see up there, the IRS just hired 300 people. They made them go through a 56-hour training course. I mean, that's a lot for the IRS. For those of you who are unaware, they are unionized. So a 56-hour training class is probably broken up over a 2-week period because they have mandatory breaks. Just that means it's important to them. They're going to take these audits very seriously. And I think on Bloomberg Tax the other day, we did see they just released the training guide. It's like 75 pages. I took a look at it. There's not a lot of it's not helpful. It basically is the FAQs in one, but it does take all the FAQs and notices and put them in one nice package for you. But if you want any of those gray questions answered, that is not going to do it for you. So,
Right. And with that, I mean, one of the things that I think people need to consider if they have maybe worked with one of these mills and have some apprehension is getting a second opinion, having someone review it, get that verified, try to correct things before the IRS comes in, corrects them for you, especially if you've already received a refund. We've heard that the IRS is halting issuing any refund over $200,000. So it may be that the IRS looks at all these before it issues these larger refunds, which is not technically an audit. So it doesn't mean you're in the clear, but it may, depending on what you, I think, disclose in that filing. So if there's an area that you think you are unsure about, it might make sense to talk to your client about how much to disclose in that filing. So you can say, hey, the IRS looked at this, or hey, this was all disclosed on the return, may provide you some sort of backup at the end of the day, sympathy at the end of the day. But we do recommend taking a second look at these things, just like a lot of the things we've talked about here, cryptocurrency. I mean, there's all kinds of situations where if you think you're potentially in the line of danger, correcting things before the IRS comes and gets you is usually a better course of dealing with these things. I mean, we've all dealt with these issues throughout our careers, and it's a big conversation, but it's a really important one.
Yeah, and the way we assess it is, somebody comes to us with an issue, and we're first asking the question, is it civil or criminal? The vast majority of what we deal with are civil issues, and there's a pathway, set of pathways. There's also the criminal side, and we work with our white collar group if there's a potential criminal issue. But I think a lot of the disputes in these areas are going to be around things like, what does this mean? What were you thinking? What was, because when there's no guidance, because we've been through this so many times where rules come out, there's no guidance, and so people, you think about like during the pandemic how politicized things were and things like that. You think people are going to look at, there's going to be a group of people that look at those government forms and interpret them much differently than the words on the forms, sort of in line with political agendas and stuff like that. They're going to sign that because they think the government owes them something. We've seen that before in other areas where people have done stuff like that. And when you have hundreds of thousands of taxpayers doing stuff like that, that's going to be a criminal pocket. But a lot of it's going to be gray area. And, it's going to come down to what evidence is available. We live in the past in terms of what our cases are. It's our oldest thing right now. I can't remember.
For me, it's 2012.
Yeah,
2010, for sure.
Yeah, 2010. So we're dealing with litigation with years at issue of 2010. It's actually not even docketed yet. We're at IRS appeals on that. And so we have to reconstruct facts. And in this case, it's large corporate things. It's a multiple billion-dollar issue that the IRS has raised. And, like going back even to books and records from 2010, when that was 3 generations of systems ago. And, it's just that's the importance of maintaining contemporaneous documentation. Like we can use the Internet Wayback Machine, right? Just like anybody else. But there are issues associated with that. credibility issues. If you have a copy of the webpage or download from that time, we can look at the metadata and show it was from that time. We can use that. And so, yeah, that's our world.
I just wanted to give you my final thoughts on this ERC credit because every single one I've seen from one of these ERC pop-up shops, there's been no analysis, and the client was just completely unaware. I mean, these aren't these are reputable companies, and they're taking it for the word of these pop-up shops that they entitled to this credit of $1.5 million. And that's not going to save the day when you get audited by their IRS and you have no documentation that you relied on these guys.
Well, and are they even qualified tax professionals? I don't think we've seen the qualifications of these people that show. There may be some enrolled agents in some of these organizations, but we're not seeing, CPAs and tax attorneys necessarily at a lot of these organizations. And that's going to hurt the taxpayer at the end of the day.
So just talk to your clients if they're doing this. You want to take a look at what's going on.
So with that, we're
Out of time.
Yeah, we'll conclude the Denver Tax Conference, and thank you all for coming, and hope you found it useful.